So this is chapter 1, part 2 of our lecture videos. And just as a quick review, we were talking about the business. The business's objectives are twofold. First of all, profitability, the ability to generate income, revenues exceeding expenses, and also the firm's liquidity position, the ability to pay debts when coming due, particularly short-term debts coming due within a year. Also, the business has a number of different activities, 3 specific activities: operating activities, which are day-to-day activities; investing activities, which are longer term, having to do with growing the business beyond its existing scope; and number 3 is financing activities, which basically address how the capital is going to be raised to basically provide for both the operating and investing activities. So again, all these 3, as I was mentioning earlier, are interrelated. So operating activities hopefully are generating cash to help fund investing and to repay any debt that might be borrowed as a financing activity. Investing, obviously, will hopefully someday increase the ability to earn more money through the operations, and hopefully will provide money to repay financing. And financing, of course, will be necessary in the interim to provide the capital to make the investment for the long term. And hopefully be repaid through long-term growth of the company. So again, all those 3 activities are interrelated, as you can see here. They all kind of relate back to each other and relate to one another. So again, all these activities go on in every company, and of course are driven by the 2 business objectives. So how does accounting fit into this? Accounting really is the language of business. And when we say language, it allows us to quantify the objectives that we've set forth and the activities that we've talked about. So it's a way for us to understand how we're doing relative to our objectives, whether we're meeting those objectives and to what extent. It's also explaining to us what the results of the activities are, and where we're going to need to, for instance, obtain additional financing, what our shortfalls might be on the operating side, and allows us to see the full scope of the picture from a financial point of view. So without quantifying these activities, we're never going to know how successful we are or what we're going to need to do in the future. So again, it's all geared to really not just bookkeeping. So accounting, I would just highly emphasize, it's not bookkeeping. Bookkeeping is just one small aspect of accounting. Accounting is all geared toward decision making. Okay, and we'll come back to this time and time again throughout the course. Accounting is there to provide this information that's used for decision making in all aspects of the business. And that's the value of accounting. It's impossible to run a business without accounting information, and it's really the foundation for which all business decisions are made. So it's absolutely critical. So what's the process? The process really is, in accounting, we're going to capture business transactions. So that's the number 1 starting point. So anytime we do anything that affects the financial position of the company. So if we have, we purchase some inventory, we pay our employees, we make a sale of a product, we sell a service, we incur any kind of expense, we make any type of investment, any type of transaction that affects the financial position is called a business transaction. Okay, so we're going to capture those, we're going to measure them, and for the purposes of this class, it's not going to be too complicated. We're going to measure those in dollars, but there's not going to be many measurement issues. They're going to be pretty straightforward, but we'll come to some later in the course where we're going to have to make some estimates, or we're going to have some subjectivity in terms of what is the actual value of that transaction that's been incurred. From there, we're going to process those transactions. Again, with larger companies, that's going to be a fairly significant activity, in which case we're going to use computers, obviously, to do that in this day and age. It used to be done by hand, and bookkeeping was a very labor-intensive business. But with the advent of computers, even PC, laptop-based software, very large companies even can be supported by simple, laptop or PC-based computer accounting software, such as QuickBooks or something like that, Intuit. Tremendously powerful now in terms of processing that data. And then this is where it starts to become important. So what we're going to do is ultimately we're going to provide and communicate financial information, accounting information in a useful format. So it doesn't make sense just to generate a lot of numbers. The key is to put it in a useful format. And for purposes of this course, financial accounting, the output that we're talking about here are called the financial statements. I'm just going to abbreviate. So financial statements are going to be what's going to be what we're ultimately going to be preparing, and we're going to do that in the second part of the second week of the course. We're already going to understand what constitutes financial statements and how they're put together. The financial statements then are going to be used for decision making. And again, number of users, we'll talk about this in a moment. Everybody who has any dealings with the company are going to be users of that financial information. So we're talking about any investors in the company, anybody who loans money to the company, anybody who has any dealings with the company are going to be users of that information and are going to be interested in those financial statements. Now, the beauty of the financial statements is if you go back up and look at the objectives, our first financial statement speaks directly to profitability. And this financial statement is going to be what's called an income statement. So there's basically three primary financial statements, two of which we'll focus on right away, and the third one we'll focus on at the end of the semester. So the first one is the income statement. The income statement will tell us if we're profitable or not profitable. At a glance, we'll be able to see some information on the revenues and expenses to be able to understand how we're doing. We can compare that to last year. We can compare that to other companies in our industry. We'll have a good sense of how we're doing relative to that objective. The second financial statement is going to be called the balance sheet. The balance sheet is going to help us to understand what our liquidity position is and whether we have enough resources to pay our debts. So that would be the second financial statement. And then the third financial statement lines up with our activities. It shows us where the cash has come from and where it's going in terms of these three particular activities. And that's what's called a cash flow statement. And that is a little more complicated, so we're going to come back to that at the end of the semester, but just so you can see how that fits in right now between the objectives and the activities of the firm. So now we understand our financial statements. Again, the financial statements are going to be very valuable to the users of those statements to make decisions. And again, we talked about specific users of those statements, but let's just make sure we understand. First of all, there's users who have a direct financial interest. In other words, people who have money directly invested in the company. So here we would have investors, people who are buying, let's say, the stock of the company, or the owners who are investing money into the company if it's not a corporation. We would also have any lenders or creditors, anybody who has lent any money into the business and is expecting to get paid back from the business is obviously going to be very interested in these financial statements. There's also a number of indirect users too, people that are going to also have an interest in the financial statements. They don't necessarily have a direct investment, but there's lots of people. So any suppliers to the business are going to be interested to know whether the business is going to be in financial difficulty. Of course, the customers, you wouldn't buy a car from a company that you thought was going to go bankrupt. Certainly the employees have an interest. You wouldn't work for a company you thought was going to go bankrupt. Clearly governmental entities would have an interest, such as the IRS, the SEC if they're a publicly traded company. So there's a lot of, and of course the list would go on. So there's a lot of people that have an interest, and certainly employees, and one big group, of course, would be management. Management, the people who are running the company, obviously have a tremendous interest in understanding how the company is doing, and they receive a lot of that information from the financial statements, as well as other reports that the company is generating. So on top of the users, just moving along, before we get into the nuts and bolts of accounting, one thing that's important to note is that there is a set of rules for accounting, specifically financial accounting. And so when we refer to specific rules, guidelines, what we're going to be governed by is what's called generally, let me just finish this, accounting, financial accounting. We're going to be governed by generally accepted accounting principles, okay, and that's in the United States. There's also international accounting standards, and for the most part they follow GAAP, although they might be somewhat different in certain areas. And the two have probably eventually will merge, although there are some areas of difference right now. But generally speaking, and our book is set up such that we're going to be talking about U.S. GAAP. So generally accepted accounting principles, or GAAP, is going to be what's going to govern accounting. Generally, that is made up by, or that comes from the accounting profession through input from people that work with accounting. But that's generally speaking where that is set forth, and it's set forth in printed publications, and usually, and that changes from time to time. But basically, your textbook is a function of GAAP. So I think what we'll do is stop here, and we'll come back in the next part, and we'll talk about what the framework of accounting is for. So we'll talk about the accounting equation and just look at a simple example that helps to explain that.